is officially the start of the Santa Claus rally, but it seems like Santa came early this year for stocks, as stocks have been basically ripping for the last 6 weeks or so, breaking record after record after record. Here in this video, we're going to go over the latest stats and charts for our markets, discuss what is coming next, and what is the historical return of the Santa Claus rally. It's actually very impressive, and if you are bullish in our markets, well, you're going to love this video. Not because I'm perma-bullish, but because there's just a lot of good things going for stocks right now. But eventually, the walls will feel like they're closing in and crashing down again. Stocks will fall, so be prepared for that to happen as well any day now. But something is very strange that is happening around the world. The Shanghai Composite dipped below 2,900, down almost 15% from its April peak. For comparison, the MSCI World Index in US dollars is up 13% since then, 28% of a performance gap between China and the rest of the world. Now, this would suggest China is in a world of trouble right now, and if China's not doing well, it's hard for the US to do just fine. I mean, the data recently shows that the economy is actually accelerating by about 5.2% in Q3. Estimates for GDP now are right at about 2.5%. How is the US doing so well and China is not? I think there's a reason for this, potentially, given the drastic difference between performance here from China versus the rest of the world, and I think we'll find out what's going on under the surface very soon. Short sellers have been getting destroyed in recent years, posting a $176.3 billion profit in 2022, down about $155 billion or so in 2023. 2021 was a brutal year, down about $134 billion. 2020 was even worse, down $182.7 billion. In 2019, down $122.4 billion. I mean, putting two and two together, you would think that you wouldn't see as many shorts on our markets today as maybe prior years. Considering stocks have been on a relentless rally, this would make sense. And especially as the economy is holding up, inflation is falling faster than expected, and the Fed's gonna give us 6 or 7 rate cuts according to where the markets are currently pricing Fed policy by December of 2024. This all sets up for what could be a very aggressive end of the year rally and start to 2024. The SPY has drawn about $40 billion in inflows in the month of December, on track for the biggest monthly haul since it began trading in 1993. And no other period of time even looks close to this within the last 12 months or so. Even during the summertime rally, the most you hit was about $11 billion or so in a single month. The second highest, what looks like here on this chart in recent times, was August of 2022 during that summertime rally, and that was only about $14 billion that went into the SPY. Game of Trades on X reports in just 33 trading days, the S&P 500 equal weight index has gone from a 52-week low to a 52-week high. This is the second shortest 52-week low to high run-up in history. The fastest one occurred in September of 1982 and took only 16 trading days. Back in 1982, this was really the start of about a 5-6 year rally for stocks before we got the 1987 crash. This was the low of 82, and this was the high before the 87 crash. I mean, this is a huge gain. If we plot out the low to the high, you were up about 236% in this 5-year span. That's a pretty good average return. So this parabolic rise recently might signal we could see a multi-year rally for the S&P 500. As you can see, in 2023, the average stock actually did poorly compared to the SPY index itself, or technically the S&P 500. You can see that the median stock return was 16% lower than the S&P 500. The last time you were this low was during the dot-com crash of 98, 99, and 2000. What actually happened for the next 5 years after you hit a 22% underperformance back here was 5 years of outperformance by your average stock on the index. So the S&P is equal weighted. So that means Apple, Microsoft, your top 10 or so stocks control almost 40% of the index. If those stocks do poorly, then your other stocks in the index are likely to outperform, right? So your median stock might just outperform for years, which in other words would be smaller, less known, small mid-cap stocks. Some of your interest rate sensitive names also likely outperform big time. And honestly, if we avoid a recession, that doesn't seem too unrealistic. Small cap stocks are trading at record low valuations, only trading at about 12 times forward earnings for the next 12 months. Even the S&P's at 19%. That's one of the reasons why so many people are starting to turn bullish on small cap stocks, including Tom Lee with Fundstrat, which believes IWM, the ETF for small caps, could rally 50% next year. And let me tell you, he was the only one that got 2023's market prediction right. He said the SPY would be at 475 by the end of 2023. He said that in December of 2022. Where is the SPY at right now? 475.57. He was literally spot on, almost down to the penny. And we still do have a couple trading days left of this year. But I think I agree. 50% next year is not out of question. But if you look at something like the 10-year, 3-month yield curve inversion, you'll see that every time you've been inverted, you've went into a recession pretty much. And you're almost at a record inversion. The last time you've seen this was 1987. But I'll tell you, the inversion is not a telltale recession indicator. What the inversion is actually telling you is that the Fed is just raising rates aggressively. And the policy is staying there. Because if 3-month treasury yields are higher than 10-year, that's actually normal during a Fed rate hike cycle. It's just telling you the Fed was raising rates during these inversions, right? That's what happens towards the end of the hiking cycle. Well, this time around, the hikes went a lot higher than what a lot of people were expecting. So 10-year treasury yields were lower than 3-month treasury yields because the Fed had to raise rates so much. So although this looks like it's a for sure sign we're heading into recession, it's not that definitive. All it says is the Fed was raising rates, and usually when the Fed raises rates aggressively, a recession follows. Doesn't have to happen though. Household cash and equivalents are at unprecedented levels, with U.S. household liquid assets sitting at about $1.8 trillion, just barely off of the lows that it looks like you set in early 2022. Just for context, you were only at about $900 billion in household liquid assets back during the Great Financial Crisis. So you're up about a 100% gain from there to 1.8 trillion. This could potentially give the consumer a little bit more cushion, and if the consumer can just keep spending through whatever pockets of weakness we're seeing in the economy, then that recession just might not come. Here you can see a chart of recessions in pink and expansions in blue. You can see recessions are getting a whole lot less common. You've really only seen 2 recessions in the past, 20 years or so. You had the dot-com bust and the '08 Great Financial Crisis. If you want to count Rona in there, you can, but I don't think that was a normal recessionary environment. So it looks like the US is just becoming more resilient to slowdowns, and we're on a steady kind of track here for steady growth. And it's been that way since really after the inflation wave of the 80s. And remember, if you're bearish for 2024, you are betting on a 4th bear market happening in a 6-year time period. The last time this has happened in S&P 500 history was literally never. So if we go into another bear market in 2024, that would be a first for stocks. Ryan Dietrich says, how bad are things? He is the chief market strategist at the Carson Group. He says stocks are at all-time highs, gold is at all-time highs, home values at all-time highs, bonds up 5% for the year after a historic 2-year bear market, net wealth at all-time highs, debt relative to incomes nowhere near historic highs. Things appear to be better than most think. 12 Reasons to Remain Bullish in 2024 by Ed Yardeni. If you don't know who Ed Yardeni is, you need to do some research on that guy because, yeah, he's very respected on Wall Street. I'll just say that. Interest rates are normalizing down. Consumers have purchasing power. Households are very wealthy and liquid. Demand for labor is strong. Onshoring boom is boosting capex spending. Housing is all set for a recovery. Corporate cash flow is at a record high. Inflation is turning out to be transitory after all. The high-tech revolution is boosting productivity. LEI mostly misleading. Rest of the world's challenges should remain contained, and the roaring 2020s should broaden the bull market. Morgan Brennan from CNBC says core PCE deflator's 6-month annualized rate has fallen below the 2% target. New Edge Wealth Benz Amans says, quote, it took the Fed just 3 months of holding a restrictive rate in place since July, when the Fed's fund rate reached 5.5% and treasury yields and mortgages hit 15-year highs. The 6-month annualized PCE was cut in half. So really the biggest reason why stocks have been rallying so much is because inflation has been falling faster than expected. Some people were bracing for 3 to 10 years of inflationary pressures, and it looks like PCE, CPI just continues to fall. And the fact of the matter is, if inflation goes away, the odds of a recession are much, much lower. Inflation falling also means that long duration growth stocks are going to be worth more, because if you have 5%, let's say, inflation every single year, if it takes 10 years for your company to, go from a nobody to from a small cap to, let's say, AMD or something. AMD did that as well. It took a little bit longer than 10 years. But I mean, if you have 5% inflation every single year, your earnings 10 years from now are going to be worth a lot less than they are if inflation is 2% a year. So that does also take a hit to valuations on top of the odds of a recession and where the Fed keeps Fed funds rates. Goldman says, quote, our most out of consensus call for 2024 is our 2% forecast for 2024 Q4 to Q4 GDP growth, well above consensus of 0.9%. Consumer spending will easily beat expectations because real income should grow about 3% and household net worth is close to an all-time high. So Goldman Sachs continues to believe people are going to spend a lot of money in the next year. Jim Bianco, he runs Bianco Research, says that traders and investors are waiting for January to either close trades or initiate new trades. So the market roars out of the box in the new year. This chart shows you the average move week by week for the S&P 500 from 1927 until today. And you can see volatility really slows down in the 49th week to the, end of the year, essentially. And that's probably going to be no different. It looks like this week you've already started to move big. Tuesday, the day after Christmas, was a big move relative for stocks. The Russell was up over 1%. The NASDAQ was up over 0.5%. And it looks like stocks might continue to run further from here. But the first week of any new year tends to be the most volatile. And that's because you're probably going to get a lot of funds that need to do some buying here just to catch up to where they need to be allocated to stocks. The fact is, if you are a fund manager and let's say you gave me money, I invested it, I got 10%. Great. But if you watch the SPY return 22%, then you're going to say, what am I doing? Right? If my fund manager cannot, give us results like the S&P and exceed those, there's no point in paying a 1% management fee or whatever this specific fee is. Tom Lee, the head of research at Fundstrat, says year-to-date, 65% of large cap fund managers were trailing the S&P 500 returns, but only 47% of small caps were trailing the S&P 500. So 65% of funds did not beat the S&P 500. in 2023. Last year was even worse. About 70% of funds underperformed the S&P 500. So this is 2 years in a row. They cannot afford to get this wrong in 2024. They have to outperform the S&P. That is why I have been steadfast in saying small cap stocks will outperform in 2024. Unless we go into a recession, unless we get recession fears that last a long time and money that needs to be allocated to stocks just rushes back into Magnificent Seven names for that quality, well, small cap stocks are going to drastically outperform. Again, small cap stocks are trading at record low valuations in contrast to the S&P, which is near historically high valuations. Go ahead and pause the video if you would like. These are the tech stocks that have the most buy recommendations heading into 2024. These are personally the names I would probably want to stay away from the most, because most of these names are either at new all-time highs, hit new all-time highs on Tuesday, or very close to them. You could probably make the argument that mega cap tech gets sold in the beginning of 2024 and money goes into small cap stocks, because how much more are you really going to get out of Google, Uber, some of those other names that are on that list? They've already rallied huge in 2023. 2024 is the year of small caps. So in theory, you lock in the profit in the beginning of 2024 on big tech. You go into small cap stocks on the heavier side. You hold some cash on the sidelines. And then out of small cap stocks, you likely massively outperform. So you could take profits there by the end of 2024. And then you sell your stocks that you have losses for tax loss harvest purposes. I mean, that seems like the strategy I would probably go with personally if I was a fund manager. I mean, take a look at this statistic from Seth Golden. He says, boom, that just happened. Summonation Index closed above 900 for the first time in at least 6 months. Historically bullish signal. Forward 12-month positivity rate is 94%. Only 2 failed signals that occurred in 2007. Prior to 2023, December of 2020 signal led to a 26% rally in the S&P 500 in 2021. Need another reason to expect higher prices in 2024? The S&P 500 is currently up 8 weeks in a row. 1 year after previous 8-week win streak saw stocks higher 16 out of 18 times. 1 year ago, we noted that many reasons we expected a good 2023 and still see more positives than negatives for 2024. This comes from Ryan Dietrich, again, the head market strategist, chief market strategist at the Carson Group. So in 2024, your biggest danger if you are a bull is a recession. But long before you enter into a definitive recession, you have recession fears. And that's usually what crashes stocks. Just recently, in October of 2022, at least it feels recent, stocks sold off big time, not because we were in a recession, but because it was feared we were heading into a recession in the beginning of 2023. So use that context to the same way in 2024. If we start to head into a recession, if things start to look bad for the economy, stocks will fall. That's your biggest longer-term worry or longer-term pressure. But any day now, stocks could take a breather, start to sell off a little bit for seemingly no reason, just because the RSIs are overbought. At 73 for the SPY, IWM is at 75, and the triple Q's sitting right at about 73. So you're overbought, but you're not too bad. I honestly think there's more reasons for stocks to go higher from here than lower, but just on a relative strength basis, stocks do not go up in a straight line forever. There will be some sideways trading. There will be some, downside trading action, but overall, you don't want to be bearish for too long, or you don't want to be hedged for too long, at least in my personal opinion, but I'm not a financial advisor. Tuesday, December 26th was the first day of the official Santa Claus rally that will last from the 26th through the 2nd. Now, the reason for the Santa Claus rally is really nobody knows. It's a market anomaly more than anything else. Some theories for the rally include increased holiday shopping, seasonal spirit, and institutional investors settling their books before going on vacation. Historically, from 19 1950 through 2022, the Santa Claus rally was positive about 80% of the time, with growth in the S&P 500 by 1.4%. That's better growth. That's a better return than most months for stocks, basically all single months for stocks. So that's a pretty impressive short-term bullish period of time for stocks. As you can see here, since 2002, so about 11 years now, during the Santa Claus rally, there was only 3 times where the markets were red. That was 2008, 2012, and 2018. In 2019, you were green, positive. 2020, you were positive. 2021, you were positive. 2022, you were positive by about 1%. And 2023 so far looks good. So maybe I would wait to put on any of those hedges until the Santa Claus rally is over. Just personally. Let me know what you guys think about all of this information. Are stocks going to continue higher? Are, stocks going to fall? Should you hedge? Should you sell? Should you be buying more? What are you doing with your portfolios? Personally, I think a 50% rally for small cap stocks is not too unrealistic for 2024. And I think that is truly the place you want to be. That's where my portfolio is positioned. For those of you guys that made it to the end of this video, I plan to talk about all of these stocks separately or group them together in some videos. But Fubo, SoFi, PayPal, for the interest rate sensitivity, Tesla, Snapchat, Crocs, Dollar General. These are names that should do very well in 2024 that have already started to do well. So you've already gotten some degree of confirmation that the theory is intact, right? They've been outperforming the markets recently. And that's probably going to continue from here. So let me know what stocks you are also investing in. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.